Well, good afternoon, traders. Here we are, Monday, 15th of July 2019. I'm Paul here with session 47 of the Admiral Markets webinar series, Mastering the 4 M's of Trading. As always, before we begin, we'll start with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying videos for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. The presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients could use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from an unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payout of £50,000 sterling as per our negative balance protection policy. There are many good reasons to trade with Admiral Markets, as you can see there, for two of the most popular trading instruments, DAX 30 and Euro Dollar. They offer competitive spreads during the main market hours, and they also offer the MetaTrader 4 and MetaTrader 5 platform with the also Admiral Markets Supreme Edition plugin. And Admiral Markets are a truly global brokerage that are regulated and registered in several entities across the world. If you speak to your account representative, they'll be happy to guide you to opening a trading account with the most suitable entity for yourself. So as always, ladies and gentlemen, these sessions are about educating you on the 4 M's of trading, so you can go away and analyze any market and be ready to trade it, and also help you raise your self-awareness about managing risk and managing yourself. As always, we have a broad range of experience throughout the rooms. We're, as always, limited by the time we have available, which means that we can't always go into topics with the depth that people would like, but we try and focus on tools that you can utilize tomorrow in your own trading business. And as we all know now, the mastering the 4 M's of trading has always been about understanding markets, method, money, and myself, and actually working towards mastering it within inside our own trading business in order to help us grow and develop and be the very best traders that we can be. So we've had the sort of kind of sessions over the last few weeks. We're down here to the last 4 of the sessions. Last week we had session 46 on markets, which you will find on the Admiral Markets YouTube channel and Facebook page. Today we're going to talk about methods. All right, that's second M. And next week's session, which will be recorded and placed onto the Admiral Markets YouTube channel and Facebook page, will be on money, and the final session will be a wrap up on managing myself. So, we've talked about, really drawing towards the end of the series. We just bring together all the elements that we've touched on and learned over these last few weeks and months. We've talked about how we prepared for our trading day, how we follow our 10 steps, okay, to make sure that we have process, discipline, and self-awareness. We talked about last session about the different types of markets, okay, and about market analysis. Today, we're actually going to have a recap of, how we choose our entry, what are our trading methods, so that we're able to manage our risk, record and view our trades, and look at how we manage our trading performance, which is what we'll touch on in the last session in 2 weeks' time. So, we've got quite a bit to go through in terms of, the method, because we covered quite a lot of them earlier on in the series. So today is just going to be a little bit of a fly through, just to kind of, give you a recap, an overview, and just ensure that, you fully understand the different sort of methods that we have shared with you, and about, the ways you can utilize them in your own trading. So if you remember, what we talked about right at the beginning was that, when we look at trading and investing methods, there are thousands of them out there. Okay, you can go onto the internet and Google for them. Okay, and you'll find thousands, all sort of different ways and different prices. And what we're really sort of looking at is that when you break it all down, what you're looking at is you're looking at either a break of a line of support resistance or a bounce off a line of support resistance. And that's as simple as that. And that's what we've always been trying to do in these sessions, is just break it down into its most simple elements so we can understand exactly, how to sort of not only understand but master it and utilize that in our own trading. So if you remember, we went through a whole host of different kind of methods, okay, different tactics that you can take away and utilize in your own trading. A very simple one, a very popular one is trading the pin bar, okay. So pin bar, as it looks like, it's it's based on the name of the Pinocchio bar, okay. If you remember Pinocchio, the Disney character, when Pinocchio told a lie, his nose got bigger and bigger. And what we see in trading is when we see the sort of the big nose, the big wick on a pin bar, it's lying because it's actually it's actually pointing one way, but we expect the price to go the exact opposite way. What we look for, okay, in a good pin bar is that the open and close of that pin bar should be within the range of the previous bar, that it should actually have a wick 2 to 3 times the length of the body. We like to see a long nose protruding from all the other bars. And the better pin bars, they stick out. They're very obvious, ladies and gentlemen. And if you don't actually have to have been trading for very long to be able to just look across, a broad spectrum of charts on any, time frame and on any instrument, and you would find that invariably, you'll see pin bars across the entire spectrum. So, what we talked about was how, the pin bars are the likely indicators of where the biggest predators are lurking. That's why we look at them, because they show rejection of a particular area or direction of market. As a private trader, what we guide you on there is it's pointless to try and fight them. Okay, don't try and fight them. Work with them so that you can utilize them to show you the likely short-term direction. And ideally, what we like to do is we look to trade with the trend, and that's what we've always talked about. Okay, sort of identify a trend, wait to see how price pulls back and reacts at particular levels of support and resistance, and look for a confluence of events. If you get a good pin bar or a good price action signal there that's all come together at one particular time and place. So, then what we talked about was an engulfing candle pattern. Okay, quite a simple pattern. They don't happen very rarely, but they're they've got good probability around them, because what they do is they demonstrate total overwhelm. So ideally, what we do is we look to trade them at the ends of trends because they're a reversal pattern. So we look for a bullish engulfing candle at the end of a downtrend, and we look for a bearish engulfing candle at the end of an uptrend, and we look to trade in the direction of the close of the engulfing bar. That was the engulfing candle. Very simple. As I said, they don't happen very often, but when they do, they're very well worth taking note of. What we then also looked at is the 3-bar reversal, okay, and in terms of actually how to trade pullbacks in a trend. We just looked at it being a simple mechanical pullback trading tactic. 1, define if there is a trend. 2, wait for a pullback to support or resistance. And for a long, then what we're looking for is 2 seller bars followed by a buyer bar. Or for a short, okay, in a downtrend, we're needing 2 buyer bars followed by a seller bar. That's actually all we were looking for. It's quite a simple mechanical setup, okay, in terms of we're looking 3 bars. The element of subjectivity comes in about what does the actual sort of buyer bar or sort of trigger bar look like, and where has it actually been placed in terms of at a level of support or resistance in a particular trend. So, what we talked about is in terms of the most simplistic view, okay, if price is in an uptrend, then, what we're looking for is price to pull back towards a level of support, which could be dynamic support, like a moving average, like, 20-period moving average, okay. the or it was on the excuse me, or on the a big round psychological number or a horizontal level of support resistance. Okay, but ideally, what you're looking for in the simplistic view is two red bars followed by a green bar. And that's it. You could trade it quite simply as that. But what we like to see is if that green buy bar, that trigger bar, is also a pin bar or an engulfing candle or an inside bar, or perhaps a dojo, a spinning top, well then that just gives us more confidence. That just makes us more interested in the actual trade setup as well. If you remember then, we looked at the inside bar, okay, which is, in some respects, the exact opposite of the engulfing candle that we looked at. The high and low of the bar is fully within the range of the preceding bar, right? And this is where we're looking at markets and thinking of it like an organism breathing, okay? Markets surge, they then rest, then they surge again. Simple as that. The inside bar is the rest, and it's when the inside bar prints, okay, as part of the pullback, okay, as part of the rest, then what we're doing is we're looking to position ourselves to catch the next surge. That's what we're looking for. We look to trade them as pullbacks in trends, ideally. So, if we're looking at and find them on weekly and daily setups, then you can utilize 4 hours to execute and manage them based upon the size of the bars themselves. And just one thing you have to do is decide on whether it's an entry on the break of the bar or the break of the actual range based on the size. So, if what we mean by that is, the sort of the range of the inside bar, okay, is very close to the range of the mother bar beforehand, okay, and if there's not much range, well then we'd probably look to trade the break of the entire range. But if it's a very small inside bar, okay, and it's away from the level, then we'd probably trade the break of the inside bar itself, the kind of the high or the low of the inside bar itself. We also know that they can be used in true breakouts. We wait for the breakout to occur, then we wait for an inside bar to be printed, and then we trade that in the direction of the breakout. And that's just quite simple. It's quite visual as well. Okay, that's what lots of new traders helps them. They're able to see it clearly identified on the chart itself. Then we looked at key day reversals and also momentum reversal candles. That's one of the things that we particularly looked at, especially KDRs. Okay, they turn up. When they turn up, we definitely are always interested in them as traders. So, a key day reversal is a sharp reversal pattern that occurs during a trend. So, in an uptrend, prices open to the equivalent or above the previous day's close. They make a new high, and the market reverses during that day and closes beneath the previous day's low. In a downtrend, prices open to the equivalent or below the previous day's close. They make a new low and then close higher than the previous day's high. Greater the price range and volume on the key reversal day, the more reliable the signal. These don't happen very often, unfortunately, okay? But when they do, it's really important that you take note of them. They provide some great trading opportunities, okay? They are, as the name implies, they're a key day reversal, okay? It's a reversal of a trend, and it's a significant day's worth of trading activity, and that's what we need to keep on top of and see and actually utilize for our own trading decisions. Then we looked at momentum reversal candle, okay? So what does that mean? Well, as I said there, in an ideal world, we'd like to see and trade key day reversals. However, key day reversals do not happen as often as we'd like. However, a version that does appear more frequently is what we call MRCs, or momentum reversal candles. So, for a basic long setup, if you remember, what we talked about is, we're talking about here on weekly or daily candlestick charts, but actually, all of these setups, they will operate across the broad spectrum of trading timeframes. So if we are looking for a buy for a trigger day essentials, well, what we see is that price is in a downtrend. Price makes a new low, but closes higher than the previous day's close, and also the low is lower than the previous 3 to 5 bar closes. Okay. The important thing is that it closes higher than the previous day's close. For a key day reversal on to the long side for a buy, what you would need it to close higher than the previous day's high. All right, but a momentum reversal candle just needs to close higher than the previous day's close, and that's actually why they appear more often than key day reversals. And when they appear at the right time and place, then they can be just very effective trading ideas, trading opportunities as well. So we also talked about something simple called the 1-2-3 KDR combo. All right, as the name implies, we're just bringing together a couple of simple sort of price action setups that can help us in terms of making our trading decisions. So if we talked about it, after a good trend, I take an interest when price prints an individual reversal candle on the daily and or the weekly charts. All right, that's the first stop. And it might be something like a key day reversal or engulfing pattern or a price, pin rejection bar. Okay, these things happen, and that's where we start to take good notice of them. Then once we've printed a something like a key reversal or an engulfing candle, then I wait for a 1-2-3 pattern to form. All right, because this then also helps provide a lower high. Remember, I'm not trying to pick the exact top here. I know that's what lots of people try to do with reversal trades. I'm not just trying to pick the exact top. I'm actually happy to wait to see the price play out a little bit, so that I can get a better lower risk trade for myself. Part three is, what we'd like to see is point three of that 1-2-3 should be a rejection or an indecision candle. So something like, a pin bar or an engulfing candle or a spinning top. You just see there, okay, the point one is a key day reversal. Okay, price pushed to new highs, but it closed way beneath the lows of the previous couple of days closes. And then a very price falls, and then it tries to push its way back up, and it provides a 1-2-3 pattern there. And that the pattern, on three it's a good pin bar, it's a good rejection candle, and that gives us an ideal opportunity to be short on that particular market. Also, we talked about optionally, right? But what also helps give you some great results is ideally the 20-period moving average, or whatever fast moving average you may use, should now turn from support to act as dynamic resistance, right? And that acts as a roof, capping any further move north. That also just helps us. And we'll touch upon that in a few slides' time. Which leads us on to the PO20, the power of the 20-period moving average, something we talked about quite a great deal, because once a market has printed a reversal pattern, we can use the 20 MA as confirmation of a reversal. We watch to see how does price react to the 20-period moving average after the reversal pattern, and does the 20-period moving average provide dynamic support or resistance? If you remember when we just talked about our charts there throughout this series, we've just described the 20-period moving average there as the blue line on my chart, right? Blue is 20, red is 50, green is 200. What we're looking for is we're looking to see if the 20-period moving average will act as either a new roof, all right, for shorts, or as a new floor for longs. When the 20-period moving average acts as a significant dynamic area of interest, then we can have confidence to trade in the direction of the reversal. And then, once we see the power of the 20-period moving average, then we can utilize any of the price action setups we've previously discussed as a trade setup for us. What do I actually mean there? Let's just use it whilst we're here. What we can see is we had a very nice double bottom there, okay? W there, nice double bottom. We can see that actually earlier here, the moving average, the blue period moving average had acted as resistance, okay? Until price turned over and came over the other side, and suddenly it went from being as resistance to actually being as support. And then finally, what we had here, okay, as you can see there, is we actually had a couple of pin bars there, okay, a couple of pin bars. The 20-period moving average has gone from sort of being down, okay, to actually turning around and heading north. Whilst we've still got the that which is also a reversal pattern going on as well. So there's 3 or 4 things that are all coming together at once. Remember what we were saying, that allow us to basically find and utilize a good trade setup. And what we're here, just another example, is having had a nice uptrend where we can actually see the 20-period moving average was acting as good support. Once we topped out here again, price sort of fell down, and then it's actually when price comes back up here that we start to notice that actually, here we go. What we've noticed is the 20-period moving average has sloped over. That 20-period moving average is now acting as resistance. Okay, it's now acting as a cap on moves, and actually what we can see is this is what actually happened there for on that particular sort of trade of the euro yen. And a little example there. Another example. This is sort of oil on the weekly chart. Okay, just to show that we see these trades set up all over the time. We can see that price has been in a downtrend. We can see that the 20-period moving average has acted as dynamic resistance. Then what we had was we had a nice W pattern, a nice 1, 2, 3 pattern. Price rallied north. Then it basically came back, and what we can see is that that 20-period moving average has started to sort of awaken from its slumber. It's now acting as dynamic support, and actually what we can see is the price of oil rallied its way up, okay, for the rest of the year, just off the back of that. And we can see how that power of 20, okay, when price came back down, it couldn't get back beneath the 20-period moving average, and that was just a nice, easy trade setup for us. And just another couple of examples there. I appreciate because it's not one we've shown as much. This is the Nikkei on the 4-hour chart. Okay, price moves down, it double bottoms there. Okay, puts in a kind of a bit of a standard W formation there. Okay, which we can see, and then price actually gets to sort of fight it with the 20-period moving average, and actually we can see that in that particular case, sort of the Nikkei is doing very well. Okay, it's starting to rise again, based on how it had seen the sort of Nikkei perform against the 20-period moving average. Just more examples, okay, of this market's turning, okay. We see a reversal pattern, which we'll touch on in a moment, followed by the 20-period moving average sort of reversing, and then it goes from being dynamic resistance to dynamic support, and that gives us our trade opportunity. Which kind of leads us into the 1, 2, 3 pattern, which we've touched upon a little bit before. But I appreciate as a recap, we can go through and pick up all of these salient points. So, a bearish 1, 2, 3 formation, okay, is normally what we see is we basically see this. We've got a point 1 followed by a point 2. Price tries to rally again, okay, but it can't break point 1, and actually price runs out of energy and it rolls over and price collapses, and that is a 1, 2, 3 formation, which we see across all sorts of time frames in all sorts of directions. Normally, when you do this, you'll be actually looking to sort of sell on the break of point two, but a lot of this is depending upon what type of trader you are, and understanding yourself as a human being. So what you can do, I appreciate, we have various levels of people watching in terms of experience, skills, but also in terms of their attitude towards risk. And if you understand your attitude towards risk, and if you're able to sort of still manage it very well, well, then actually one of the aggressive ways to trade a 1, 2, 3 is to sell on the break of the line of drawing a line between the level 2 and level 3. Once price has broken through that, well, then we are actually in towards having an established 1, 2, 3 formation being created. And if you want to really be ultra aggressive, okay, you try to cater for all manner of risk profiles on these sessions. If you want to be ultra aggressive, then you can sell on the break of the high test, the pin bar candle that makes 0.3, as long as one or two of the other elements lining up. And those kind of other elements were things like maybe you're bouncing of a privet particularly for an intraday trade, or you had an aggressive trend line, okay, that was giving you with some coverage, and or alternatively maybe utilizing a nice pullback into the 50 to 62% fib retracement zones. I'm always surprised at how many traders will actually happily use a fib drawing tool, okay, and treat it as gospel, but won't actually understand how it was created in the first place. Okay, you might not necessarily need to be a superstar at each one of those particular areas, but what you are looking at is is doing the best you can to be the best you can be in one of those areas at least. Okay, because invariably that helps all the other traders out there. So just remember that a 1, 2, 3 pattern could be a double top. All right, that is a reversal pattern. Just be reminded of that when you see that. For a bullish formation, well, it's pretty much exactly the opposite. Okay, what we've got here is a 1, 2, 3 pattern. Hopefully, you can see that very clearly for yourselves there. Hopefully, you can enjoy that. And once again, standard convention is that you would sort of break it. Okay, as price broke it, you would stand back and let it go. But a bit like the bearish one, if you wish to be very aggressive, if that's the kind of style of trader you particularly are, well then you might actually want to break out on a sort of drawn line between the levels of 0.2 and 0.3, because that will give you a good indication of where you are in the map. And a bit like the bearish ones we looked at there, if you wish to, you can buy on the break of the reversal candle at 0.3. If it's something like a hammer or a low test or a spinning top, that works really, really well for us. You can see that yourselves. And then we talked about sort of general chart patterns. Okay, what were the sort of general chart patterns that traders look at, and what we can actually sort of employ in our own trading today. Using two lines of support resistance, there are various chart patterns that can be traded. Those types of chart patterns are continuation patterns or reversal patterns, as the names imply. So we've just for this series, we've just focused primarily on continuation patterns. Okay, bulls and bear flags, are ascending and descending in triangles, and symmetrical triangles. By all means, you can become endeavored with the sort of reversal patterns, and an American politicos wanting to sort of chase Mr. Trump and take photos of him everywhere. But I think most people still prefer to see him sort of trading as he does. So we talked about general chart patterns, flags, all right, bull flags and bear flags, how they show, how they are created. Remember, the continuation patterns are expecting we're expecting to sort of see the price continue, standard price continue in the direction that it actually entered that pattern. Same with the ascending and descending triangles. They're good continuation patterns, and you can see them developing over time, especially when you're trading on sort of 4-hourly, daily, and weekly charts. And symmetrical triangles, you'll sometimes hear me refer to them as like coils. It looks like price is coiling up before it's getting ready to blow out, and that's what we're particularly looking at. So you can always print this particular page off, stick it on your own wall charts, okay, on your own wall, so you've got it there in front of you to remind you, okay. As always, the more you practice looking for these, the easier you will find them in the future. And there's a little sort of kind of a crib sheet of reversal patterns, but for the basis of this particular series, we're focused mostly on continuation patterns. But as we transition towards the new Admiral Markets Trading Spotlight webinar program, we'll be building it in, okay, some reversal patterns as well as continuation patterns to help you enlarge your trading knowledge. What we looked at is a couple of simple reversal patterns. One of the major ones being the head and shoulders pattern there that we can see that what we're looking to see is price will draw a left shoulder, it will come down, start to head up to the head and create a neckline, and invariably what we're looking for is as price falls down there, okay, comes back up and forms a right shoulder as it comes down to actually break the sort of neckline again. Or this is actually where we're looking to have our entry and our stop loss normally above the right shoulder. That's the kind of standard way of trading in the sort of head and shoulders patterns. That's it. That's just an inverse head and shoulders pattern. Just remember, just one flipped on its tail. Okay, first shoulder is there. Okay, what we're looking at is price forms the head pattern, it falls away and tries to get back up for that second shoulder before it actually turns around and price starts to rip its way north. Okay, it's they can sometimes be a bit tricky, but when they work out well. You can be guaranteed some good long-term profits when such a trade does well. We're looking at double tops and bottoms, all right? So, M and W formations, that's what we're often seeing. That's what people particularly like. That's, exactly, and we see them across all sorts of time frames and all sorts of instruments, all right? And normally what we're looking for is that we see a kind of a particular position starting to form in the second leg. Well, then actually we know where our resistance level, our neckline will be, and we're looking to sort of get ourselves aboard and back into the game. Triple tops and bottoms are just very similar to double tops and bottoms, just with one extra top or bottom in there, right? Sometimes a market needs a triple top or bottom just to basically help enable it get across its breakthrough in terms of breaking its neckline and going on to be a good trade. So we've talked about methods and a method review. All right. Well, you'll find, to finish up, traders often talk about trading strategies, systems, methods, and trading plans. What do they actually mean? Well, a trading method is the overall process and trading style that is used to profit from the markets. A trading method can be defined as principles used to successfully trade in lots of different markets. Trading systems or trading strategies. Well, a trading system is a set of rules that qualifies or quantifies buy and sell signals as demonstrated by successful testing on price history or chart studies. A trading system is the specific kind of data or knowledge used to execute the trading methods based on the price action or fundamental valuations. These signals are triggered by measurable technical indicators or key levels on charts, and that's what I've been getting you to look at yourselves. Just start to identify those particular key levels, because that will tell you an awful lot. And in terms of a trading plan, well, a trading plan is a set of rules, okay, consistent with a trader's chosen methodology and system that governs how trades will be executed in real time. The rules determine whether what will happen based on the trading system entries and exits, risk management, psychology. Trading plan is meant to keep the trader disciplined and safe from their own weaknesses, while providing the parameters for consistent profitability. So remember what we said, that trading system, it involves a possible sort of trade a breakout. You're trading a bounce off support resistance or a breakout of support resistance. It is possible to trade both, but you will find that each of us will develop a bias, okay, subject to sort of keeping an eye on your present subject of future winners. So, what we talked about, trading systems involve an entry signal, exit signal, winning percentage, risk to reward ratio, position sizing parameters, frequency of trading opportunities, average expected annual return, and maximum expected drawdown. And the actual triggers for that within that, the method review, they're very often similar to what we see ourselves: pin bars, engulfing candles, inside bars, 3-bar reversals, key reversal, momentum reversals, and key day reversals, along with 1, 2, 3 combos. And if you're starting to get all of those family involved in your trading, okay, then you'll cover all of the bases. So, there we go. That was just a quick methods review. As always, we just very quickly finish with the quick steps through our 10-step plan. Step 1, okay, remember, define levels of support and resistance. Whenever we open a chart, whether it doesn't matter what it is, just open that chart, start the monthly, the daily, the weekly. Define levels of support and resistance. Step 2, define if there is a trend. Step 3, wait to see how price reacts at those key support resistance levels. Step 4, look for price action signals at support and resistance levels. Step 5, just be aware, is it part of a bigger chart pattern that we are seeing forming? Step 6, define your risk, accept it, stick to it. This is what we're going to be touching on next week. Step 7, rewards, all right, targets or trailing, know your exits. So step 8, you can keep scrupulous records of your trading. And step 9, improve your performance by debriefing your trades, so that you can achieve step 10, which is all about repeating the way you go about your business, because consistency and discipline are key to success. So, as always, in terms of mastering the 4 M's of trading, okay, just have that big picture recap, and remember to manage those 4 M's of trading: markets, method, money, and myself. Just check, are they all in alignment, or are all of those parts of you happy? And if they are, well, that's great. If not, well, then you shouldn't expect outsized returns, okay? So it pays for you to constantly monitor those particular 4 areas. As always, if you have any particular questions about this session or any of the other sessions available to you as Admiral Markets clients, you can contact us for a discussion. We always enjoy engaging with our clients, and you can call them on that London number 02035 140 756, or email hello@admiralmarkets.com. We've got a YouTube channel there, youtube.com/admiralmarkets, and the terrible one also is the opportunity to contact on Facebook.com, the Admiral Markets Global, if you can't access YouTube.com, the Admiral Markets there. So there you go, ladies and gentlemen. I hope you found that useful. I hope you found that just a nice recap of quite a lot of the methods that we covered there. We've shared quite a few with you there over the last few months, because appreciate that you will all have your own ways and means. You'll all have your own particular styles, your own particular pleasures in terms of what ways you like to trade and engage with markets. As always, as I said, if you have any issues, just contact us here on Admiral Markets, 02035 140 756, or email us at hello@admiralmarkets.com. Next 2 weeks, okay, will be based on managing money and managing myself. As always, we wish you the best of success in your own trading, and look forward to speaking to you soon. Many thanks.